Hello and welcome back to Depreciation Lab. In this video, we are covering WDV method, written down value method, which is method of depreciation mandated by Indian Income Tax Act for all business assets. If you are calculating tax depreciation in India, this method you must use. Now at its core, WDV is a form of declining balance method. You take a fixed percentage and apply it to the remaining written down value of the asset, not the original cost at the start of each financial year. So as the asset's book value falls, the depreciation amount falls with it. This is what it makes a declining balance method and an accelerated one. You get a larger deduction in earlier years. But here is when Indian tax law introduces something unique, a concept of block of assets. Under Indian tax rules, you do not calculate depreciation for individual assets. Instead, the Income Tax Act groups similar assets that share the same depreciation rate into what is called a block. So all computers in a business are pulled into one block. All motor vehicles go into another block. All office furniture into yet another block. You calculate depreciation on the total written down value of the entire block, not the each piece of equipment individually. The third point on the screen is important one. WDV tax is a compliance method. It is required for your income tax return. For your financial statements under the Companies Act, you might choose different method completely, straight line for example. That is fine. WDV specifically and only for Indian income tax purposes. WDV sometimes called reducing balance method, same concept, different name. The block concept means that adding a new asset to the block or selling an asset from the block affects the entire block's WDV, not just one asset. Unlike MACRS in US, India's WDV has a concept of property classes determined by useful life. It used depreciation rates set directly in the income tax rules. Now let's look at exactly how the block system works and see the actual depreciation rates for each major asset class. This slide shows you exactly how a block system works in practice and what depreciation rate applies to each major asset category. Let's start at the top. Computers and peripherals, laptops, server, printers carry the highest rate at 40%. This makes sense. Technology depreciates quickly in real life and the tax law reflects that. If a block of computer has a written down value, say 10 lakh rupees at the start of the financial year, the depreciation for that year is 4 lakh rupees. Motor vehicles, whether a passenger car, trucks, two-wheelers carry 15% rate. Plant and machinery also comes in 15% for the most general manufacturing equipment, though there are higher rates for certain specialized machinery. Buildings are split into two categories: non-residential building, your factories, offices, commercial properties depreciate at 10%. Residential buildings provided for staff like quarters or hostels carry a lower rate, just 5%. And the furniture and fittings, desks, chairs, fixtures are depreciated at 10%. Now the crucial thing to understand about these blocks is how addition and disposal work. When you buy a new computer during the financial year, its cost is added to the computer block. When you sell an old computer, the sale proceeds are subtracted from written down value of that block. The depreciation is then calculated on the block's closing balance. There is an important rule here. If the sale proceeds from the disposal exceeds the written down value of the entire block, meaning the block's value becomes negative, the negative amount is treated as a short-term capital gain. It is only at that point that the sale triggers a tax event for the block. This is very different from how individual asset disposals work in the most other systems. If all assets in a block are sold and the block WDV becomes 0 or negative, the block is terminated for that year. A negative block WDV means total sales proceeds exceed cost and prior depreciation, triggering capital gain. The rates shown are standard rates. The Income Tax Act allows higher rates for the assets used in certain industries or for a specific type of pollution control equipment. Always verify with current Schedule 2 of the income tax rules. Plant and machinery used in manufacturing may qualify for additional depreciation of 20% in the year of acquisition, an extra deduction on top of the standard WDV rate. Now that we understand the block system, let's cover the 3 key rules that you must follow when applying WDV: the financial year, the 180-day rule, and the no salvage value principle. There are 3 key rules of WDV that you must keep always in mind, And let's go through each one. Rule number 1, the financial year. Unlike calendar year used in many Western countries, India's tax financial year runs from April 1st to 31st March. This might seem obvious if you are based in India and already familiar with it, but for anyone dealing with cross-border accounting or setting up WDV in software, that is the first thing to configure correctly. Depreciation Labs WDV calculator automatically aligns all calculation to the Indian financial year, so you do not need to manually adjust rates. Rule number 2, the 180-day rule. This is the most important nuance in entire WDV system, and it catches many first-time users off guard. Here is how it works. If a new asset is put to use for a fewer than 180 days during the financial year in which it is first acquired, you are not only entitled to claim 50% of the normal depreciation rate for that year, you are only entitled to claim 50% of the normal depreciation rate for the year. For the year 2 onwards, the asset is in the block and gets a full rate. No more half rate adjustment. It is only ever the first year that is affected. Rule number 3, no salvage value. Just like MACRS in United States, the Indian Income Tax Act does not recognize salvage value for tax depreciation purposes. A block of asset keeps depreciating as long as it has a positive written down value. There is no floor. The block theoretically goes into indefinitely, though in practice the assets are sold and proceeds reduces the block. The 180-day rule threshold is calculated from the date the asset was first put to use, not the date of purchase. If you buy an asset in September but do not put to use until November, the clock starts from November. The financial year rule means quarterly reporting in India is based on April to June, July to September, October to December, and January to March quarters, not calendar quarters. Even if you sell an asset for a scrap at the end of useful life, the sale proceed reduces from the block WDV. They do not create a separate gain unless the block becomes negative. Now let's look at 180-day rule in complete detail with a worked example showing exactly what happens to the first year depreciation in each scenario. Now let's go through 180-day rule with concrete examples so there is no ambiguity. The Indian financial year runs 1st April to 31st March, that is 365 days. Half of 365 days is 182.5 days. But the Income Tax Act uses simpler threshold of 180 days. So the cutoff date for the standard April to March year typically falls around October 3rd or 4th. Asset put to use on or before that date gets a full rate. Asset put to use after that date around October 4th through 31st March gets only 50% of the normal rate in the first year. Look at scenario A on the screen. A computer is purchased and put to use on 15th June. The financial year starts on 1st April. So from 15th June to 31st March, the asset is in use well over 180 days. The full 40% rate applies here. On the cost of 1 lakh rupees, the year 1 depreciation is 40,000 rupees. The written down value at end of the year is 60,000 rupees. Now look at scenario B. The same computer, same cost of 1 lakh rupees, same 40% block rate, but this time it is purchased and put to use on November 10th. From November 10th to 31st March is only 141 days, fewer than 180 days. The 180-day rule kicks. The rate for year 1 is reduced to 20%, which is half of 40%. The year 1 depreciation is only 20,000 rupees. The written down value at year 1 would be 80,000 rupees. 20,000 rupees more than scenario A. From year 2 onwards, both assets are in the block and gets the same full 40% rate. So the practical lesson here is this. If you are planning a significant asset purchase, try to put it to use before 180-day cutoff, which in a standard Indian financial year is approximately 3rd or 4th October. Doing so doubles your first year depreciation deduction. This is a straightforward tax planning opportunity that is easy to miss if you are not aware of the rule. The exact cutoff date can shift by a day depending on whether it is a leap year. Always calculate from 1st April minus 180 days. For businesses with non-standard accounting year approved by tax authorities, 180-day rule calculation adjusts accordingly. Additional depreciation under section 32(1)(2)(a) for manufacturing plant is also subject to 180-day rule. You only get 10% additional depreciation instead of 20 if the asset is used fewer than 180 days. Depreciation lab automatically applies the 180-day test based on the date of the first use you enter. The calculator handles the rate adjustment for you. That completes our walkthrough for WDV method, the block system, the financial year alignment, 180-day rule, and no salvage value principle. If you are using depreciation lab for WDV calculation, all these rules are built in directly into the engine. As I mentioned, the depreciation lab contains a full-fledged suite of calculation reports from 3CD, which you can use readily to file tax return for the depreciation of assets. So we will go through in detail about WDV India tax method in future videos. So look out for the video and subscribe to the channel, and I will see you in the next video. Thank you so much.